The S&P 500, what exactly is it? The S&P 500 is a publicly traded index fund that holds shares of the top 500 US companies by market cap, giving us a really good view at what the market looks like in totality in the US. S&P 500 tracks almost 80% of the total US market. But why is the S&P so important? Well, you see, a lot of investors use the S&P to kind of gauge how well their portfolios are doing. The S&P has a pretty good average rate of return annually, and so investors will like to see if their other investments are kind of matching up to the average. A lot of analysts also use the S&P to kind of gauge how the market in totality is doing, if the economy is good or not in the US. If you have any type of retirement account, a 401k, anything of that sort, the odds are it's probably linked to the S&P 500. It is such a large index fund. The S&P 500 was created by a company called Standard & Poor. See, before 1957, there was the S&P 90, which tracked 90 of the top companies. But in 57, Standard & Poor made the Standard & Poor's 500. This was revolutionary because it used computers to track real-time stock prices. The S&P 500 has quickly surpassed the Dow Jones as a way to look at how the US market is doing. Since it tracks such a broad variety of the market, not just a single sector, it gives us a really good idea of how we're doing. The S&P has withstood a lot of crisis, even in COVID. In 2020, the return of the S&P was 18%. The S&P is also always moving and changing. It regularly kicks out companies and adds companies in because it's dependent on their market cap. So how exactly does the S&P work? In order to be included in the S&P 500, you must have a market cap of at least $14.6 billion. It seems like a lot, but it's really not when you look at stocks. They also must meet a certain profitability requirement, meaning that over the last 4 quarters, they must have returned a profit and cannot be negative. The companies must be US based and actively traded. And lastly, these stocks are picked by a committee, not just automatically. So there is strategy going into what stocks get included and not. The S&P 500 is what we would like to call market cap weighted. What this means is that companies that have a larger market cap like Apple of $3 trillion have more influence than smaller companies like Etsy who have a market cap of about $6.5 billion. This means that if Apple is doing really well in that index fund, it's going to move a lot heavier than if Etsy was doing really well. The S&P changes its weights as stock prices and market caps change daily. The S&P 500 currently tracks 11 sectors in the market. Sectors like technology, consumer cyclical, communication services, consumer defensive, utilities, basic materials, financial services, healthcare, industrials, energy, and real estate. Like I mentioned earlier, the reason why the S&P is so important is that people like to call this a mirror of the US economy. If the S&P is doing great year over year, most likely the US economy is doing great year over year. The S&P also just provides a consistent benchmark on how your investments are doing. Over the past 100 years, the S&P has returned about 10% every single year. A lot of people investing in the stock market like to get caught up in the day trading and the swing trading. The volatility can either make you a lot of money or kill a lot of money. This is why the S&P is such a good long-term financial investment, because if you can just hold it year over year, you're kind of guaranteed 10% return on your investment. What makes the S&P different though from say the Dow Jones or the NASDAQ? For example, the Dow Jones. The Dow Jones takes 30 of the largest blue chip price per share stocks in the US. So despite market cap, if you just have a large price per share and you're a blue chip stock, you're kind of included in those 30 companies. This isn't a great view on how the overall market is doing, but it's a good view on how the big companies are. Another good example is the NASDAQ. The NASDAQ is another index fund that has over 3,000 US companies in it, but its main focus is technology and growth. So again, great view on how the technology sector is doing, but not a great view on how the overall economy is. This is why the S&P is so beautiful. It's the gold standard of how the total US market is doing. Investing in the S&P 500 is super easy. There's plenty of exchanges that you can use. Personally, I like to use Robinhood. On these exchanges, as an investor, you can buy ETFs or index funds that match the S&P 500. You see, these ETFs, they're not actively managed, meaning that there's not a specific broker managing your positions. This makes things a lot cheaper compared to having someone actively manage 500 companies for you. There are a lot of benefits to investing in the S&P. For example, diversification. Again, you're investing in over 500 different companies with large market caps. 2, the ease of use. You don't have to worry about figuring out which next stock is going to blow up when you can just long-term invest and know that there's going to be a good return. And also the low cost. Since it's not actively managed, you don't have to pay large fees to have a return on your investment. Instead, just sit back and relax. Like I mentioned prior, large market cap companies that are influential like Apple, Amazon, and Microsoft have very large holds on these indexes. The S&P is rebalanced quarterly, meaning that every 3 months, there's companies getting kicked out and companies coming in. In 2020, Tesla actually got included into the S&P 500 and was a very large deal. All in all, the S&P is the foundation of investing. It's so easy, brainless, and diverse that I don't see why you wouldn't invest into it. That kind of summarizes everything that I have in regards to the S&P 500. But if you like this video, please like the video down below, consider subscribing, and DM me on Instagram at Ruben Uzun, or leave a comment down below if you have any questions regarding investing or stocks. Other than that, thank you guys for watching. See you next time.